Yeah, I think the fuse is lit. I've said for years I thought that uh, silver would be the fuse on gold, and it's looking pretty squeezy right now. When I say squeezy, from the short squeeze standpoint, we've been in a supply deficit for 5 years, and that's only broadening. It's not coming back to balance. And the only thing really that can balance the supply deficit out are higher prices.
Bill, thank you so much for coming in, parachuting in at a very appropriate moment, I think. Because what's running through my head, and in fact, as soon as I saw silver breakout, I recall you saying, I'm talking about years and years and years ago, that silver would ultimately bring down the entire fractionally held house of cards. And so now we've got the US short of silver for military and industrial purposes. They've had to recategorize silver as a critical mineral. It looks very much like the fuse is lit, my friend.
Yeah, first, thanks for having me, Andrew. Yeah, I think the fuse is lit. I've said for years I thought that silver would be the fuse on gold, and it's looking pretty squeezy right now. When I say squeezy, from the short squeeze standpoint, we've been in a supply deficit for 5 years, and that's only broadening. It's not coming back to balance. And the only thing really that can balance the supply deficit out are higher prices. Now, the problem in the metals industry is that the supply chain is relatively inelastic time-wise to price. You could discover gold or discover silver today, hit the mother lode, but you won't be in production for 7, 8, 10 years just because you've got to build out the infrastructure. You've got to get all the permitting, et cetera, et cetera. So it's an unusual market compared to, say soybeans or whatever. You just plant more for that year to make up for a deficit. You can't do that with silver. And I think ultimately, silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. And the problem with the gold market breaking, when I say break, I'm talking about contracts basically going to zero and physical being not obtainable. The problem with that is gold is a thermometer, barometer, whatever you want to call it. Much, much higher prices means that confidence has or is breaking. And the entire Western world's financial system runs on confidence.
And I remember you long time ago saying, arguing that, it's not that the price of gold has gone up. It's just that it's taken more debased dollars, euros, yen, whatever, to buy that very same ounce, which has not changed at all.
Right. An ounce 100 years ago of gold or an ounce today or an ounce 100 years from now is still just an ounce of gold. It doesn't change at all. The only thing that changes is the measuring stick, and that measuring stick are currencies. And currencies worldwide are going down because gold has broken a new highs in all currencies. That's over a 99% drop in purchasing power. And that's happening with other currencies. And we can talk about yields, if you'd like, sovereign yields, because they're going higher worldwide. And that's the real tell as to what's happening.
Yeah. So what are you seeing? What are you seeing as far as, yields are going, see it in this country, we see gilt yields going through 1998 highs. What's happening on your side?
Well, yields across the board, sovereign yields are defying, if you will, what the central banks are trying to do. The central banks have started to cut. We're going to probably get an interest rate, a Fed rate cut this month in September. Go back a year ago, the Fed made, 3 cuts totaling 1%. So short-term rates dropped 1%. But while that was happening, long-term yields rose by 1%. So I think the danger with this September rate cut is that they cut rates and we get a sell-off in bonds. Now, that said, well, that would show the Fed losing control of the yield curve. And that's important because obviously, it's the biggest market, and all financial markets are based by a foundation of paper, of U.S. Treasuries. Now, that said, I think the most important yields to watch are the Japanese 10 and the Japanese 30-year bonds. And the reason they're important is because for years and years and years, when Japan was zeroed out as far as interest rates, the yen carry trade is what a huge factor in blowing this bubble to where we've gotten to. And a stronger yen and higher interest rates or lower bond prices, what that does is that's going to unwind the carry trade. So for years and years and years, leverage was put on the long side. And with these much higher yields and a stronger yen, that carry trade is being forced via margin calls to unwind. And when you get something of the size of the carry trade unwinding, it cannot ultimately be a slow, conservative drop. I mean, this is going to be, it'll be some wild times.
I guess I'd really love your feedback on this because obviously we have a lot to talk to, a lot of people. And basically, because what we see is the global central bank sovereign institutional de-dollarization process is underway. And because the bond price is kind of dictated by foreign buyers or the nominal price of bonds. I mean, it looks like, to me, it looks like if this bond yield, if it reached as high as 5%, this was the level that was told to me, they figured that would be the inflection point that would trigger yield curve control. Is that about right? Or
yeah, well, 5% was the high. We're 4.25 thereabouts now on the 10-year, but that was the high on the move. Up from, at one point in time, I think the 10-year traded as low as 0.6 of 1%, or maybe even lower. So it's been a huge move already. And, I don't know if 5% is the number or not, but there is a number that unwinds the entire credit edifice. Because what you need to understand is that the entire world, whether it be financial markets or the real economy, everything runs on credit. And if credit becomes more expensive because it is being shunned by foreigners, how does the U.S. How does the U.S. fund a $2 trillion deficit? That's an extra $2 trillion every year that they have to borrow. And the answer ultimately is the Federal Reserve will buy those bonds. But that is, outright and direct monetization. The problem that the West is in right now is it's a debt trap. We're paying in the U.S., we're paying $1.5 trillion in interest alone. You've got problems in France. You've got problems all over the world with sovereign debt. There's too much of it. How do you service it? That's why they're desperate to get yields down. But Mother Nature, market, is pushing rates higher. And that's where rates should go because there's more and more risk. There's little to no risk premium in sovereign bond yields across the globe.
And so essentially, the way that just so subscribers understand what we're talking about, so yield curve control is essentially going to flood the market with cheap money, isn't it? And so what's your hedge? Global central bank gold buying is going to certainly be incentivized. What's the hedge for most people?
Yeah, well, the obvious hedge is gold and silver. And the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely. And I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. And I mean, obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side. But essentially, what we're hearing is, hey, gloves are off now. And especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs, and then most recently some very odd statements that he made after the SCO meeting. What's your thoughts there?
Yeah, I think your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. Mm. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into, whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those.
And I think most recently, and I know we're recording this on the 3rd of September, so it's not really a time-sensitive thing we're talking about here, but essentially what just happened, and I don't think this is clearly not going to change, is that it's quite clear from Trump's comments that the SCO meeting between these major hubs that you're talking about, and military powers as well, really ruffled the White House's feathers here. And they're not handling it very well, because basically, I guess really, I mean, maybe I'm naive to think, wouldn't it be better to have a multipolar world where you take all the barriers down? But I guess US dollar hegemony is the problem here, is it?
Well, that's the problem that the rest of the world sees. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they'd prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023. And you can look at a gold chart The following day after that news came out, the price of gold started going higher. It's been like a tractor in first gear. The pullbacks, or what used to be smashes, have been very, very shallow. And here we are, we're breaking out, we're new highs on all-time highs on gold, 14, 15-year highs on silver. We're entering a new phase right now. And I think that new phase coincides with the Western bond market. Think the Western credit system is faltering. And it just makes sense. If the credit system's faltering and everything is based on credit, you want to move your assets into something that cannot bankrupt. And that's gold and silver by definition.
Yeah, and you'd mentioned freezing the Russian assets and how obvious that inflection point was. And that was pretty shortly followed in November of that 2022 by the Bank of International Settlements squaring all the remaining of their 500 tons of swaps, leases, derivatives, and clearly revaluing gold as a first-year high-quality liquid asset on the 1st of January. But the funny thing is, and I was just looking at Goldman, Financial Times, I think today, on the 2nd or the 3rd today, they published something from Goldman's desk. And Goldman says, hey, clearly there's a lot of unreported buying. So while the World Gold Council show that acceleration of demand, they then show a red dotted line that says, oh no, there's a hell of a lot of unreported gold. And essentially then we speak to our liquidity providers, who one of them is a Goldman guy, and he says, oh no, it looks like, what they're saying is officially, it looks like unreported is probably around about 33,000 tons. But he said, more realistically, we think it's 42,000 tons. So, so much is going on under the radar here. And that's probably because a lot of, when you think about the gold that's flowing into China, gold and silver flowing into China, it goes through 42 customs districts, which have 680 individual customs offices. There's so much fiddle room here. It's unbelievable. And of course, we've known for years, people look the other way. It's probably very likely, and the feedback we get, this is military. This is to stock up military critical assets. Gold and silver are critical minerals.
I spoke about this probably back in 2016, 17, 18, with the amount of gold that was coming into Shanghai, was many, many, many multiples of what the government has raised. What are they at? 3,200, 3,500 tons, something like that, China officially. The real number absolutely has to be over 25,000 metric tons, and that's triple what the U.S. says we have, and we haven't audited since 1956. So I think clearly China has way, way more gold than they say they have. I think probably Russia too. And just go back to the old saying, he who has the gold makes the rules. And that's what they're preparing for. They're preparing for the dollar/bonds, treasury bonds, to implode. And that if a country has no gold on their books, on their balance sheets, then they're stuck with that black hole of loss. Whereas if they've hedged and now have a good sized position in gold, what they lose on dollars, they're going to more than make up on gold.